Bismillahirrahmanirrahim. Continue our comprehensive example. We reach to cash budget. Here is company have cash budget here for the year ending December 31st of December 2014. We assume that 2014 is the coming year and the current year is 2013. The cash budget have the following format. We start with beginning cash balance from the question, from the illustration we have here. The question gives us the beginning cash balance, which is $38,000. Here from the illustration, from the question, we go back. Illustration, have here number 1, January 1st of January, cash balance is expected to be $38,000. We have here wish to maintain balance at least of $15,000 here, at least of $15,000. Want to maintain a balance, the at least, okay, permitted to be more than 15,000, but is not permitted to be less than 15,000. We prepare the sales of the collection from customers schedule, and we prepare the direct materials or the payment to vendors schedule in the previous videos. To continue our example here we have schedule of expected collections and expected payments. From here we have the components of the cash budget. Cash budget are prepared according to cash basis. Then every amount here must be either collected or expected to be collected or expected to be paid in 2014, which is assumed to be the next period. Then we have the components of cash budget: beginning cash balance, receipts, add receipts, disbursements or payments, and financing. Then ending cash balance. Here we note that ending cash balance for quarter 1 is the beginning cash balance for quarter 2. Ending cash balance for quarter 2 is the beginning for quarter 3. Ending for quarter 3 is the beginning for quarter 4. And ending for quarter 4 is the ending of the year balance. And it's the beginning of the next year, 2015 balance. And the next year, 2015 balance, the first quarter of 2015. Okay. Continue. Here we have collection from customer first quarter, second quarter, third quarter. Here from where these amounts are from schedule of collections is here. Schedule of expected collections from customers. We have 168, 198, etc. Then here we have expected collections from customers, and we have sales of securities. In the illustration in number 3, the illustration said that the company expect to sell investments in securities of $2,000. Then if we go back here if we go back to the illustration number 3, short-term investments are expected to be sold 2,000. We must here concentrate on cash. If it's not cash, will be not shown in cash budget. It must be cash. And here he said in the first quarter, then we put the investment sales of investment at the first quarter according to the question. Okay. Then the total here we have 168,000 plus 2,000. We have 170,000 total receipts. Here we don't have any sales of investments. Then we have here 198,000 total collections or total receipts. Here total receipts same as here, total receipts same as here. Then we have here the beginning balance plus the total receipts. We have here total cash available or total available cash. Here we have the beginning balance with total receipts. We have the total cash available. Here we have total cash available, etc. Continue to cash disbursement. Then the total cash available is total receipts plus beginning balance of cash. Disbursement, we have direct materials. These amounts, when we purchase direct materials, we expect to pay to the vendors or the supplier these amounts. These amounts comes from the previous schedule here. In the previous video, have expected payment to the vendors or to the suppliers 23,200 the first quarter, 27,200 the second quarter. Here we have these amounts. Direct labor. Direct labor, in the example here, he said in the illustration that we have 5 in the illustration 5 direct labors. 100% is paid on in the quarter incurred. Then we do not delay the salaries of the labor or the wages of the labor. Then 100% is paid in the quarter incurred, and manufacturing overhead and selling and administrative expenses, all items except depreciation, are paid in the quarter incurred. Then we don't delay payment of the manufacturing overhead expenses and selling and administrative expenses, except for depreciation, which is non-cash expense, and we don't pay depreciation. Then depreciation must be excluded from the selling, administrative, and manufacturing overhead. Here, if we go to our cash budget, then direct labor, we have here from direct labor budget. We talked about direct labor budget in the previous videos. We have direct labor budget. We have 62,000, 72,000, 82,000. You must go back for these videos to see how we reach to these amounts. Then these amounts are expected to pay in the same quarter incurred. Then in the quarter 1, we expect to incur 62,000 and pay 62,000. In the second quarter, 72,000 incurred and paid, etc. Then we have here 62, 72, 82, etc. Manufacturing overhead and selling and administrative the same way, but we must here exclude depreciation from both items here, from both manufacturing overhead and selling and administrative. Okay, for manufacturing overhead, we go back for manufacturing overhead budget. In the previous videos, we discussed manufacturing overhead budget. We must go back for these videos. We have here these amounts, total manufacturing overhead. But these amounts, we must exclude from these amounts depreciation. From this amount depreciation, because depreciation is not a cash expense. We must exclude it from the total manufacturing overhead. 57,100 minus 3,800. We have here 53,300. As you see here, we exclude depreciation. For the second quarter, the same thing here. For the third quarter, the same thing here. We exclude from every quarter 3,800 depreciation. And for selling and administrative, the same way. For selling and administrative, how we reach 41,000, 43,000, we go back for selling administrative. We discussed selling administrative budget in the previous videos. We reach to the total amount here, which is 42,000, 44,000. We must subtract the depreciation. 42,000 minus 1,000, 41,000, 44,000 minus depreciation, 1,000 every quarter. Then we have here 42,000 minus 1,000, we have 41,000 and 43,000 for the second quarter, etc. 42,000 minus 1,000 here, the calculation here, and the calculation here for manufacturing overhead and selling and administrative expenses. If we go back to our for purchase of truck, go back to our illustration. We have here in our illustration number 7, management plans to purchase truck. in second quarter for 10,000, we must here notice cash. If we don't set cash, then it's not related to cash budget. Because he set cash, we will put 10,000 at the cash budget in the second quarter we expected. Then we will go forward for cash budget at the second quarter here. We have purchase truck, not first quarter, second quarter. We have payments or expected to pay 10,000 second quarter for purchase truck. We don't have here. Finally, for payments, we have income tax expenses. From where income tax expenses? Income tax expenses comes from the budget income statement. In the illustration, he said that income taxes are estimated to pay 12,000, and 12,000 in the question here. Number 8 is makes equal quarterly payments. Yes, the payments of its estimated annual taxes. We have 12,000 annual taxes. 12,000 annual taxes. Okay, we have here 12,000 annual taxes divided by 4 quarters. We have here 3,000 every quarter, equal payments for every quarter. Then we have 3,000 for every quarter at cash budget. Income tax expense 3,000. The total cash disbursement or payments for the first quarter is 182,500. For the second quarter, the total here is $211,500, $211,500, and we have for the third quarter 220,500. Here 211,500, 220,500, and here 239,500 total for the fourth quarter. This is the total disbursements: 182,500, 211,500, 220,500, 239,500. This is the total disbursement for the fourth quarters. The sum of these amounts for every quarter. For the four quarters, first, second, third, and fourth. Then, excess or deficiency of available cash over cash disbursement. If we have total cash available more than cash disbursement, total cash disbursement, then we have excess. If we have total cash available less than total cash disbursement, then we have deficiency. Every quarter we have total cash available more in quarter 1 more than disbursement, then we have here excess. We don't put parentheses here. If we don't put parentheses here, then it's excess, because between parentheses here it means deficiency. And we have here $223,500 minus $211,500. We have 12,000 here. Here we have $208,000 minus $182,500. This amount and this amount equals to 25,500. We have here 2,000. Here have 2,000. 43,000 minus 220,500 equals to 22,500. Plus it's excess because we have more total cash available than total disbursement for the third quarter. For the fourth quarter we have 277,000 400. Total cash available minus 239,500 equals to 37,900. Then we have this amount and this amount. We have 37,900. Every quarter we have excess, but we remember that from the illustration that the minimum balance must be at least 15,000, not permitted to be less than 15,000. And finally, number 9, in the illustration, loans are repaid in the earliest quarter in which there is sufficient cash. We have sufficient cash and we have a loan we must pay. That is when cash on hand is 15,000 minimum required balance. Then if we here, even if we have excess in every quarter, we must compare this excess with 15,000 minimum balance. Here we have more than 15,000, then it's okay. We don't want to borrow anything and we don't have any previous loans or interest. Then the ending balance will be 25,500 and we'll go to beginning balance here. And here we have 12,000 excess, but it's less than 15,000. Then we must increase this amount to 15,000 by borrowing $3,000. In $3,000 borrowing to reach to 15,000. 12,000 must we plus what we must borrow 3,000. We have $15,000 here, and we have here 22, and this go for beginning balance 22,500. Here we have excess more than 15,000, and we have here enough balance to pay the loan and the interest. We have a loan of 300 and we have an 3,003 and we have an interest of 100. Then we have 3,100 loan and interest. From where this 100 comes from? Income statement. Here he said the illustration said that interest expenses. In the previous videos we see that interest expenses expected to be $100, which is interest expenses here in income statement. Then here we will pay the interest plus the loan. Then 22,500 minus 3,100, we have 19,400, the ending balance, and goes to beginning balance for the fourth quarter. Then the excess is 37,900. We don't have any loans or any interest then, and we don't need to borrow anything because it's more than 15,000. Then the ending balance here 37,900. Here we finish the cash budget, the last step here. Here we finish the cash budget, and the last step will be the balance sheet or budgeted balance sheet. Budget balance sheet developed from budgeted balance sheet for the preceding year. Here we have the current year. We assume that it's 2013, and the coming year is 2014. Then we need information from the balance sheet in 2013. Here we have ending balances, building and equipment ending balance, accumulated depreciation ending balance. We have common stock ending balance and returned ending balance, and the budgets for the current year. The budgets for the current year, which is the budget we prepared in 2013 for 2014. Then if we go here for balance sheet, budget balance sheet, we have cash balance here expected to be in 31st of December 2014 is to be 37,900. From where? Here from the ending balance of quarter 4 is the ending balance of year. Quarter 4 is the ending balance of the year. Ending balance of quarter 4 is the ending balance of the year. And beginning balance of quarter 1 is the beginning balance of the year. Here we need the ending balance 37,900. Then 37,900 is the cash balance expected to be in the end of 2014. Accounts receivable, from where here we have 108,000. From where we have this amount, we go back to cash collections from customers. We see here that we have in the fourth quarter we have $270,000 sales. We expect to collect from this amount $160,000. Then the remaining is 108,000. The remaining 207,000 minus 162,000. We have the remaining amount is the balance of the accounts receivable. The balance of accounts receivable here 108,000. And at the same way we have here accounts payable. From where this amount comes 18,600. 18,600 comes from here accounts payable expected to be paid. Here we have in the fourth quarter we have accounts payable 37,200 here, 37,200 for the purchases of the direct materials, not the account payable. Purchases of the direct materials. We have purchases of the direct materials expected to be incurred in the fourth quarter will be 37,200. We expect to purchase this amount at the fourth quarter. Half of this amount, 50% of this amount, are expected to be paid in the fourth quarter, and the rest expected to be paid in 2015. Then, if we have expect to pay half of this amount, then the other amount will expected to be paid in the next year. Then the other amount 37,200 minus 18,600 equals to 18,600, which is the balance of the accounts payable. Balance of the accounts payable here on the end of the 2014, end of the fourth quarter, which is the end of 2014, 31st of December. Then we have the ending balance. The ending balance. We go forward. The ending balance expected here is the rest of the 37,000 to 37,200. The rest of the amount is expected to be paid on the coming year, and on the 2015, on the year of 2015. Then this amount will be the ending balance of the 2014. Here, common stock we have 225,000, which is come from the illustration. We don't have any information about any change in this amount. Returned earnings we have 46,480. Here, from where this it's 46,480 plus net income 47,900. Then here we have plus 47,900. Then we have here the amount which is 94,380. If we sum these amounts, put in your calculator, we have 46,480 plus the net income expected, which is 47,900. We have total of 94,380, which is returned earnings. Then the total here of the liability and stockholders' equity will be 337,980. Go back for Assets, we have finished goods inventory. From where this come? We have 44,000. 44,000, it comes from the, we go back to sales budget. Here we have $44 cost per unit of finished goods, and we have the production budget. We go back for production budget. We have here production budget. In the production budget in the previous videos, we have here 1,000 units expected to be the ending finished goods for the fourth quarter of 2014. The ending finished goods of the fourth quarter of 2014 is the ending of the year. 1,000 units multiplied by the cost per unit 44. Here we have the ending finished goods, which will be expected to be 44,000. Raw materials inventory, we have raw materials inventory 4,080, sorry, $4,080. From where this comes from? It comes from the direct material budget. We have here direct material budget. We have direct material budget. We have expected or desired ending raw materials, which is the end of the fourth quarter, which is the end of the year. Then 1020 multiplied by the cost per unit, which is 4. Then we have 1020 multiplied by 4. Then we have here 4,080. We have building and equipment. From where this amount comes from? First, we have beginning balance $182,000 plus purchases of truck. We have here purchase of truck. We see here we expect to purchase truck. This fixed asset. Then we have 10,000 plus the beginning balance of the 2014 is for building and equipment, which is 182,000. Then we have 192,000 minus accumulated depreciation. From where this accumulated depreciation comes? 48,000 from the manufacturing overhead budget, which is here we have depreciation for the 4 quarters, which is the total of four quarters is 15,200 plus total depreciation of the selling administrative on the selling administrative budget, which is 4,000 total depreciation. Then we have 4,000 plus 15,200. Then we have here, sorry, we go here for the 48,000 accumulated depreciation. 48,000 is equals to the accumulated depreciation beginning balance. We have accumulated depreciation beginning balance here 28,800 plus the depreciation expense expected in the selling and administrative expenses, which is 4,000 plus 15,200 total depreciation at manufacturing or in manufacturing overhead budget. If we sum 15,200 plus 4,000, we have 19,200 plus the beginning balance 28,800. Then we have here the total of $48,000. 192,000 minus $48,000. When we have, then we will reach to the net here carrying value, which is 144,000. Then the total assets will be 337,980, which is equals to total liability and stockholders' equity. Here we finish our comprehensive example